Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. It's generally related to three different topics: wealth building, commodities, and/or financial topics. So we're going to dive right in, take a look, see what people are sharing, and I'll share my opinions as we go through it. If you want to follow me, it's at @Finding_Finance. And if you want to join our community, finding-value.com, that's where I dive deeper into all of these topics, looking for potential investment opportunities. It is Saturday, and that is when we're having our 7 a.m. question and answer session today, Mountain Time. So if you want to join, you can hop on that call and you can interact with me on a Zoom call where the link is located on the website. Coming on down, we've got modern investing. Oil prices and refining margins are down for the third quarter, and Petrobras was able to grow net income in BRL by 22% year over year. Ordinary dividend currently at 13%. Petrobras made 6.9 billion in free cash flow versus 11.3 billion for ExxonMobil. Exxon's market cap is 6.3 times bigger, and that is the valuation discount that Petrobras has in relationship to ExxonMobil. So they are increasing production, or at least they grew net income by 22% year over year, and they are far cheaper than a lot of the other options on the market. Massive tech outflow last week. Bank of America. We've got tech outflows past 4 weeks, the biggest since 2002, and a lot of people selling tech, even though the Nasdaq has been going higher. We're getting tech outflows. After 12 down days in a row, the benchmark VLCC, which is a tanker index, turns up today at plus 5%. And there's been a lot of selling pressure going on across the board. In tankers, in dry bulk, there's been some selling pressure. There's been selling pressure in energy services as well. Lots of selling pressure across the board in October and November timeframe. A modest crude build during build season is neutral. We remain in line with the bottom of the 5-year cloud range in terms of U.S. crude oil stocks. We're still very low. So the question is, well, why is oil down so much? Good question. I don't know the exact reasoning there. Could we see weakness in demand? We're not seeing it. Is there weakness in inventory levels? No, we're outside of the cloud here. So everything points to stronger prices from where we're located. The dot plot suggests that oil should be $85 a barrel, and we are far below $85 a barrel. We are just after the elections, so maybe that had something to do with it. Maybe people were trying to drive the price of oil down for cheaper gasoline for elections. Tough to say. But right now, everything looks favorable for oil to go up, not down. And we're also very cheap in relationship to gold. We're at a very cheap ratio. So there's nothing I can point to in oil to say, it's overvalued, which it's not, it's undervalued. And there's nothing from an inventory perspective or anything that looks bearish. Maybe the markets are looking forward, and maybe there's something that is spooking the markets looking forward. Something to do with the slowdown or recession, maybe. All I can come up with. Here's Grady. He says this inflation versus deflation index ratio chart has been in a range for 8 years. However, now it has a very probable false breakout in the making, which should send it sky high. It means that inflation is about to take off again. Get prepared for what is coming. So inflation index versus deflation index, the monthly 10-year chart coming on down, we had big moves lower from 2013 all the way to 2016, a nice pop higher for 2016, and it looks like it's trying to bottom. Right now, we've got a lot of those green or white candlesticks in this case, where we're probably going to head higher. If that heads higher, that's when commodities break. it's inflationary. And that's when commodities do well, is under inflationary periods. So that's Grady's opinion there. Investment wisdom, here's a quote. I don't know anyone who said on their deathbed, geez, I wish I'd spent more time in the office. I thought that was kind of funny. Um, I was trying to think of someone who would actually say that. like, oh man, I should have went to the office more. Gold has broken out into a resumed secular bull market, and this chart shows gold miners turning versus tech companies. The big asset rotation is starting right here, in his opinion. As said for 4.5 years, this commodities bull market will be the greatest opportunity in our lifetime. And nothing's really changed. I know we've seen some volatility recently, but these big charts take time to develop, they take time to break, and then they take time to play out. And that's the big picture view. What he says here is when price for this ratio chart goes up, larger gold miners are outperforming tech companies. And that's really what everyone's waiting for. We're waiting for this turn to occur. Technology is still at all-time highs, real high, and we're waiting for gold to basically break out, get the miners to break out, and all of those things to kind of get into motion. It just takes time, guys. And it doesn't happen overnight. It takes weeks or months, and then this thing will break. It could break violently, and then we're in a big bull market for like 10 years. So these bottoms take time, and I think everybody thinks that they just take a very quick time frame for these big Titanic ships to turn around. There's a lot of momentum in the stock market. It's been going up since 1982. And I don't know if we're going to hit a peak and go down, but I do think we could go sideways and maybe chop sideways. Maybe we do go down. It's tough to say. But those big chopping sideways consolidations that the S&P and the NASDAQ generally go through is when GDX and when gold outperforms those indices. And we're right at that turning point. Brady says commodities and TA and cycles keep your eyes on the very big picture at this stage. The ratio gold versus US CPI now has a truly historical breakout, and silver is in catch-up mode, which will lead to its massive 44-year cup and handle breakout. And I know people, they shift sentiment. When the price is going up, everybody gets all giddy. When the price is going down, everybody gets all sad or frustrated. But everything that we track from a technical perspective looks good. Like it's all playing out. What he says here is gold is a proven long-term hedge against inflation, but shorter term, it can deviate. So we want to see gold outperform the consumer price index. That's also a sign where miners are going to outperform. When gold and silver outpace the consumer price index, that's their margins. So gold and or silver is going up faster than inflation, which is their margins. Dow gold equals one. Gold channel here. It says this would not be unreasonable TA action, but can you stomach a ride to nearly $5,000, then a drop to 2,500 bucks, followed by a sprint to $20,000? If you've owned crypto, you get it. That's what he's doing. He's creating a channel. So we've got one hit here, two hit here, three, four, and then five is all the way at the top. Could we do a move where we go all the way up? And that would be a $20,000 gold if that were to occur. So it's possible, and I think it is very likely that something like that could occur. That's from inflation taking off. You need to pair it with this inflation index deflation. If this comes up, that's what's going to push gold and drive gold way up there. These are all interconnected, guys. Every single one of these charts, gold breaking out against the US CPI, gold versus the NASDAQ is interconnected. It's telling a market condition, inflation outperforming deflation, these two indexes. Low oil is even inflationary. It should be. They're all interconnected. Tech outflows is another one where we should see gold start to outperform tech, and we should be seeing outflows in tech here shortly. Here's SIL, which is a ETF. The Renko chart, Mr. No Noise. The line in the sand is clear, getting north of that line, and silver miners are descendant. So we're real close. And again, when we hit the certain market conditions, when silver outperforms consumer price index, SIL, SILJ, all these ETFs are going to get, they're going to get sent to the upside. They're going to get, they're going to send it exactly. Powell said the world suffered an inflation shock where prices went way up and didn't come back down. But that shock of central banks, whose policies have also prevented prices from coming back down. The shock the Fed will soon release will be much worse. And if they release a soon to be shock, again, we're going to see GDX outperform the technology stocks. We're going to see inflation index go up against deflation. It's all interconnected, guys. All of the charts that I'm are all interconnected. Everything is interconnected here. We've got silver and coffee, a 50-year fractal. Who is to do a similar spike or surge when the chart is so similar to the cocoa chart? A half decade long cup and handle. So a cup, a handle, and then we've got a breakout here. And below that is cocoa chart, which has a similar pattern to silver. It's the same fractal if you look at it. And cocoa went ballistic when it broke out. Why wouldn't silver do the same thing? And it probably will. So expect silver to do some ridiculous move coming up at some point here, is what Casper and myself are saying. North is asking, hey, Finding Finance, what, in your opinion, what is the most hated, oversold, depressed commodity out there today? I see lots of commodities that have pulled back from peaks, like lithium, but what commodity hasn't broken out yet and is due for a cycle spike in the next 5 years? There's a lot of stuff that looks good. I would say almost everything looks good. So, I mean, if you look at it here, I'll just pull up some charts, some ETFs to show you guys, like rare earth metals. No one's talking about that. This is a double bottom. We broke out here, and then with the with the interest rates going way, way up and the stronger dollar, we've come all the way back here. I think a lot of the commodities will go up with a weaker dollar. And right now, we've had dollar strength. But this looks pretty good to potentially break out here at any second for rare earth metals. No one's talking about rare earth metals. This is down in the boonies, though. So is lithium. You brought up lithium. Lithium is also another one that's trying to break out of a downtrend here. That's coming up real, low. We broke out here all the way out, and then we came all the way back and did a retest. So yeah, lithium looks really good. I think iron ore looks good. Iron ore is in this big uh, Livermore accumulation cylinder. So this is the Livermore accumulation cylinder. 1, 2, 3, 4, 5, 6, 7, and then the break. We've got 1, 2, 3, 4, 5, 6, 7. And then if inflation takes off, that's where you get the big move. And that correlates with stimulus in China and all that other stuff. Us building out AI infrastructure, transmission lines. There's all sorts of stuff. Building the equipment for mining. There's all of that going on. And I think this looks like an excellent looking chart here. What else is there? I think silver. Now, silver itself, it's already pulled up and it's got this monster pattern that's just gigantic here. There's the pattern there. Well, let me do this. All right, so there's the pattern of silver, the big cup and handle, right? We've broken that to the upside right here. But if you look at the mining companies, they haven't really moved that much. So when we were looking at SIL, if we do SIL divided by silver, and this is SIL divided by silver, you can see that we are still way down here. We haven't really broken out in terms of the mining companies. You can also do SIL-J divided by silver. Those are the silver mining companies. We've got this downtrend here. We can put on candles here. We've got this big downtrend line going here. And we've got a big double bottom, and we're breaking out of that downtrend. So that's coming from a real low level. all the way back up. So that's an opportunity there. And the thing that gets really confusing is this usually goes up when unemployment rate goes up and when the yield curve uninverts. But there's a whole bunch of weird stuff going on with unemployment rate by the government, I think, or Federal Reserve, and interest rates are getting pulled all around too. But I do think that this is going to work its way on up. So what is low? I think those are low. If you look at gold to oil ratio, I think I think oil's low. We're at 41. Well, no, we're at 38.2 right this second on the ratio there. So I think that this is probably a potential shoulder, head, shoulder. We're still scribing out the right shoulder. It may not be done yet. And then eventually we work our way on down where crude oil is going to outperform gold. But I think that the market condition is the hardest thing to know exactly where we're at right now. The market condition, I would have said a little while ago with the inverted yield curve and unemployment rate going up, that we were probably going to get a recession. Now, a lot of people, with the yield curve going back up, here, I'll show you guys what I mean by this. Here's the 2 and 10. Um, so this is the 2. So here's the 2 and 10. This is the yield curve. When these inversions occur, that's usually when you get recessions. And we were coming on down, and I'm like, oh, we're probably going to get a recession here. I mean, that seems reasonable. And usually you pair that with the unemployment rate. You pair that with the unemployment rate, and you get both of it turning down while the unemployment rate turns up. I mean, that's recession almost every time. And then we've got the unemployment rate turning up here, and then all of a sudden it just like flatlines. Like, what's going on here? It's interesting. And this is still, we also have a reinversion breakout here of the downtrend to the upside. It's like, what is going on here, guys? So that is delaying everything. So we could see these things start to take off. I'm seeing positive signals across the board and everything. Here's Moo. Moo, I think, looks really good. And that's your kind of base structure. You break out of it, and then you do a retest. And we're right at the retest, which is a really good entry point. And I mean, a lot of these look really, really good for entry points. So, crude oil, even platinum's cheap, palladium's cheap, the mining companies are all cheap. I would say there isn't really anything that's expensive in commodities. That I would say is overtly expensive. The tech sector is really expensive. I would probably avoid that area, but we've got the S&P 500. But people only look at the short term, and they see things go up in the short term, and they try to jump on that move. I play things from a longer perspective, like you said, next 5 years, and all the commodities look good. Everything. It all looks good to me. So I think we just buy what's cheap and hold on. That's the way that I think. But that's what I've got, guys. I don't think there's anything else left. And hold on, I don't think there's anything else. Yeah, we're gonna end it there. So that's all I've got. That's give me a thumb up for the content, subscribe to the channel, do all that good stuff. We do have the question and answer session that's probably going on right now, depending on when you guys view it. It's from 7 to 10 a.m. Mountain Time when we do those things. But right now, that's all I've got for today. So we'll catch you next time. This is Finding Value.